Yeah, welcome back. Hmm, Okay, I needed that small break now. Well, it's nice to have you here again. And what I'm going to talk about to you today is the tax exemptions and tax privileges for business property under German inheritance tax law. And if at the end you will have the impression that this is all highly complicated and you don't have any idea how it precisely works, then welcome to the club. So the only thing which you really can take away and memorize over a longer period of time is there is a wide reaching tax exemption for business property. The details are highly complicated, and that shall be enough. Well, let's begin, and let's first start with the background of why there are favorable rules for business property. You remember probably that the economic consequences of an inheritance tax for a business which is a sole tradership or a partnership or which is a small company and is still held by a sole trader or a family or so, that the economic consequences then can be really drastic. Imagine you have a small firm and now at an unforeseen time in the future, because when the owner dies, then up to 30% of the net market value of the firm becomes due as inheritance tax. So the owners will usually not have that money at hand in form of cash or on a bank account. So they will have to withdraw the necessary amounts from the firm, probably very quickly. And that means that the equity of the firm will quickly go down, probably strongly. The highest tax rate in tax class 1 is 30%. But now imagine that in a balance sheet, in the commercial balance sheet, usually you have other values shown for the property than the market values, usually lower values. So in relation to the equity shown in the commercial balance sheet, probably the drain will be far higher than 30% or so. So you will lose equity very quickly, and that will have a negative impact on your rating, because now all the ratios describing the relation between equity and the total capital invested or similar things will go down. Probably that leads to problems when you want to prolong a credit or when you negotiate no new credits. It might be possible that the interest rates go up because of your lower ranking, which you have now. And so, in addition to the inheritance tax burden, there might be in the middle and in the long run even an additional financial burden from increased financing costs. So all this is no fun for the enterprise, and that shows that the economic consequences of an inheritance tax can well endanger the further existence of an enterprise, or can even completely ruin it at once. That would have the consequences, by the way, that jobs fall away. You have a kind of a restructuring crisis, or a company needs, or an enterprise needs to take up new partners or new shareholders who bring along the additional equity which the firm lost, and so on, and all that on short notice. So that's an enormous problem. And so one might say, under certain circumstances, it might be of higher interest for the public to preserve the enterprise and to collect the money. And so there is an economic problem for firms, and one needs to look for solutions how it can be avoided or restricted, that problem. Well, just to make it clear how important or how dangerous inheritance tax always can be for an enterprise if it's still led by a family or so. There is the most famous case in German history, that was the Krupp steel factories. They were for a long time run as a sole tradership under the head of the family of Krupp. And when in the 1960s it became predictable that sooner or later there would be a change in the generation, so that the present owner was probably to die and the property would pass on to his son and heir, the tax department of the firm realized that the inheritance tax would be so enormous that the firm would not be able to survive that financial burden from such an inheritance tax. So they were absolutely clear in the prognosis. The firm has no chance. So let's say a core firm of the German steel industry would go under. In the long run, unavoidable, because, well, every owner dies. So they had to look for some solution. They generated at that time a tax avoidance model, which was even highly appreciated by the authorities because it allowed to renounce on that tax in a legal way. The idea was clear and simple. First, the sole tradership was transformed into an AG. That is possible under the Restructuring Tax Act, the Umwandlungssteuergesetz, due to special rules in a way that hidden reserves need not to be taxed, so that probably that doesn't really cost much. Then now you had an AG, and the AG had shares which were which would have been normally held by the family. Now that doesn't solve your problem, because when you hold shares and the holder of the shares dies, that's an inherited property. So you pay again, let's say up to 30% on the market value of the shares. You don't have that money, so you either have to sell the shares or a corresponding amount of the shares to get the money, and then you lose control over the firm, probably. Or you would have to take money out of the firm again. So the first step was not enough. The second idea was then, okay, we take these shares and we establish a foundation. You know, a foundation is a juridical person having no shareholders. It's completely independent. And a foundation is a property which has to be administered by the managers, the directors of the foundation, which are appointed according to a certain mode laid down in the foundation documents, the statutes. And well, the trick is that the statutes of the foundation say that the property of the foundation has only to be used in order to serve a certain purpose, the purpose of the foundation. For example, if you establish a foundation with the purpose to support financially the members of a family, the income of that foundation can only be spent to sustain or to give an income to the members of the original family. Or it might be that you establish a foundation with the purpose to support all students of a certain category. For example, if you set up a foundation and say the income of the foundation has to be used until the end of eternity to support people financially who are going to study the history of the Near East and Egypt. So, good. So The second step was to set up a foundation, and the purpose of that foundation was in the common benefit. So it could be recognized as a charity organization. And now you remember that from the chapter on tax exemptions, I hope so. One of the few interesting exemptions was you can make donations to a charity organization free of inheritance tax. Like you can deduct donations as special expense from income tax, so here you can also do this free of inheritance tax. So step 3. The shares in the AG are transferred by donation completely to the foundation. This is free of inheritance tax because it's a charity organization. Now you have the following structure. The foundation on top holds shares in the AG. Now the AG just does business as it always does. The managers of the AG will be appointed by the shareholders' assembly. Well, the shareholders' assembly has only one member, the foundation, represented by its managers. So they have the AG fully under control because they can appoint the manager. The AG can freely decide if it keeps its profits or distribute it as dividends to the shareholders, so to the foundation. And now that's really nice because under that structure, the firm has a shareholder who can never die. So you will never have any problem with inheritance tax on the shares anymore. The AG itself also can never die. Now the foundation is not established in the interest of a single family, so it also escapes that inheritance replacement tax, which is a taxable transfer or taxable transaction in paragraph 1 of the inheritance tax in Germany. So no inheritance tax anymore till the end of eternity. And the AG can freely decide which part of their profit they retain and reinvest and what they distribute as dividends to the shareholder, here the foundation. And so if the foundation gets some dividends, it always will get some, then it can spend that money in the public interest, so for its charitable purpose. So a very clever trick. Now the only thing which has still to be solved is what happens to the family members. Well, and in cases where the inheritance tax becomes so enormous that it threatens the survival of a firm here, at least of such a big firm, then very often the family itself has already so much private property that they in reality no longer need ownership of the business property. That is very often the case. Now, in that case here, well, there was probably everything invented into the firm. So there was even an agreement made between the foundation and the only son and heir of the last Krupp family head, or head of the Krupp family, because the son and heir renounced on his rights to inherit the firm in favor of the foundation, and in return for that renunciation, the son and heir got a lifelong pension, which at the time was 1 million Deutsche Mark, I believe, which was, well, what's a million? Evidently, that is enough for a luxurious life. You can't really spend more than 1 million a year without doing really hard work. So that covered all his needs for a luxurious life. And, well, from the point of view from the foundation of the firm, that 1 million per year was still a trifle. So it was a good deal for both sides involved. and the fiscal authorities respected that. By the way, this model, apart from point 4 probably, this model to reorganize a firm in order to eternally avoid inheritance tax can still be found today. Very often that happens when an enterprise or a group of enterprises becomes so vastly important that inheritance tax would really end up high, and where then the family of the owner and the owner say, okay, the first thing we have to secure is the further existence of the firm. Our personal financial situation is not what matters, because, well, we are rich enough and we will remain rich enough. What counts is the firm. We need a permanent and safe structure for the firm. So then they select such a foundation and capital company structure, which then makes the firm immune against inheritance tax. Now, very often the family wants to keep influence on the firm. They want to do the management in the future. That can be ensured just by writing the statutes of the foundation in the proper way, because you can write into the statutes, well, the board of directors of the foundation is made up by representatives of the family. At least they have a strong influence in that gremium, and so they can also make sure that the board of directors, in its qualification or in its function as shareholder of the company, appoints a managing director to the AG, which comes from the family or has been selected by the family members. So you can keep your entrepreneurial influence on the firm. And a very widespread and one could even say beloved tax-saving construction. And usually this is also appreciated and well established with the fiscal authorities, because they see, okay, here somebody renounces potentially on everything in order to save the tax, and now the profits of the firm, at least those which can be withdrawn without damage for the firm, will go for the public benefit. So this is even a good bargain for the public. Yeah, and you still see that from time to time. So this is something which you can probably remember for discussions about tax planning and international tax planning. Well, now naturally this is not a useful model for small and medium enterprises. For example, if you have a small newspaper shop somewhere, to erect a foundation in the public benefit holding the shares, and so that's far too bureaucratic. That would not work, especially when the family members are still dependent on the business property for their personal income and property. So if really their personal private wealth outside the firm is not very high, then that doesn't work. So the invention of that group foundation model was not a general solution to the business property and inheritance tax problem. So people went on with looking for solutions. And a first and very drastic idea could be that legislators could be convinced, well, taxing business property under inheritance tax is bad. So please tax only private property, and that will have the further advantage that people holding private property will be motivated to shift it into business property and to invest it into business property, so to create potentially new jobs. Now, this is a good idea in theory. The negative economic impacts of inheritance tax on business property would completely vanish. There are indeed several states who follow that principle roughly. On the other hand, if you chose such an approach, you create new problems. The first thing is, it's now a bit difficult to justify the different treatment. For example, to say, yeah, you have 1 million, you have to pay inheritance tax, and somebody else has a vast fortune of 100 million and has to pay nothing because that's business property. So you have a justice and fairness problem. You need a justification, and that justification must really be convincing. We are talking here about one person losing up to 30 or 50% of his inherited wealth and another person going out free of any charge. So this is the first important problem. The second one is to draw the line between the two areas of business property and private property. And the thing is, property can always be exchanged into the other form. So what would be predictable is, when you have an area, business property is always tax-free and private property is not, that if people feel death is coming, or if people prepare a donation, that then the existing kind of property will be changed into the privileged property, so into business property, will then be transferred, and the recipient transfers it back from business property to private property. This is the easiest game on earth. So if you do such a split concept of taxation, business property is taxable, private property, business property is tax-free, private property is not, then you must have that effect into your consideration. There is an enormous loophole problem, and so you have to draw a line, a demarcation line, probably with thick barbed wire, because you have to keep people away from happily crossing over the lines. So how do you define business property in a way that this cannot easily be abused for saving taxes where that makes no sense? It's probably very, very easy to reclassify private property into business property. For example, look to income tax. We have rules in income tax law that if a partnership has at least one business, everything the partnership holds is automatically reclassified into business and business property. That would mean if you have 1,000 houses, you establish a partnership with somebody else, and in addition to the 1,000 houses, you open up a little newspaper shop. This is a genuine business activity, so all property, so especially the 1,000 houses, would be reclassified into business property. Now, if business property in general is tax-free, that would all be tax-free. That can't be what you really wanted, because what you wanted was to exempt business property with regard to the jobs and so. If there is no firm, or if 1,000 houses have just been shifted artificially into a firm by this trick, then they do not need protection. Also, you could use a GmbH. You know that corporation tax rule, that whatever a GmbH does is automatically business income, and everything it has is business property. So you could even say, here's a GmbH, and the only thing I do with the GmbH is the GmbH gets a bank account, and now on the bank account I pay in 300 billion in cash. Now you could afterwards say, based on a merely formal view of what business property is under German law, that is now a GmbH with having only business property, and so shares in a business. That's the only thing I personally now have, and as this is a majority share, it will also be privileged. So the loophole problem is really enormous. So you have to give it justification, and you have to draw the line in a way between the two kinds of property that you can't abuse that exemption too easily. So if you want to keep that basic idea as a guideline that business property should be exempted with regard to the jobs and the survival of the firm, then you should insist that you only apply such an exemption to the property which has to do with genuinely with the firm and where it really preserves jobs, because if that's your justification, you should have an eye to that. Huh? So you will have to establish rules against artificial transformation or reclassification of private property into business property. Now, business property can always be, or property can always be sold, the amount reinvested. You can always contribute it to a firm and withdraw it. So you would especially have to look to constellations where shortly before a taxable transaction begins, let's say 100 million are shifted into the firm, and surprise, later there is a withdrawal. Or you should also keep an eye to situations where somebody inherits a firm free of tax and then says, okay, now I sell the firm, turn the whole thing into cash, and live happily ever after. Because in that case, the guy or girl had inherited a firm, but didn't keep it, sold it. Now, if you have enough of cash due to that maneuver, which has now nothing to do with the firm anymore, you could also pay your inheritance tax. So you would also have to look to who withdraws major amounts from the firm or sells the firm shortly after the taxable event, and so on. So you have to describe what contributions before the transactions you still regard as okay. You will have to describe which amount of withdrawals or which amount of selling business property after the taxable event you still regard as okay, and so on. And now the problem is drawing these lines can only be done in an arbitrary way. There is no real objective line between what is genuine business property, so what can be respected, and what has been arranged with regard to the tax. Naturally, you could ask people for their motives, but well, if that was a tax saving model arranged by the dying taxpayer, you wouldn't get an answer. And from the others, if the tax planning had been arranged by others for the dying person and the heirs, then you won't get an honest answer. Don't be naive. So the only thing is you have to describe the line objectively, and the problem is that will always be an arbitrary line. You will always let some constellations escape, which then privilege from the business exemption, although they don't deserve it. And you will probably also always hit some cases where the underlying constellation is or should be genuinely regarded as business, but where your criteria say this is suspicious, that could be arranged to escape taxation, so we don't acknowledge that part of the property as privileged business property. So you will end up with problems. Yeah, now the problem is, what can you do? The first step would be to say we restrict the property which can profit from a business exemption to that property which really serves the business purposes. So everything which does not really serve a business activity is skipped or excluded from the exemption of privileges for business property. Just go back to my example. You have 1,000 houses held by a partnership, and the partnership then opens up a small newspaper shop. In that case, we have a business, the small newspaper shop, and we have all the rest, 1,000 houses. What they are is not a genuine business. They are merely a capital investment. So it would be appropriate to say the newspaper shop and the business property serving the newspaper shop, that is what we want to protect. The capital investment, the merely passive ownership of 1,000 houses, is completely different. That should be kept out of the exemption and the privileges. And indeed, this is approximately the line which the German solution chooses. They say the first thing you have to do with business property, if it comes to the question if it can be privileged, is look for so-called administrative property. So assets which do not really serve a business function, but which could be a mere capital investment, like houses, real estate property rented out to others. So not the office building of a firm, it is real estate, but it serves the administrative purposes of the firm, so that would be okay. But if it's a house rented to tenants, then it's clear, even if it's held by a business, this is not genuine business property. Cash, financial assets, accounts receivable could also have been collected and then transferred into the private sphere. It's nearly the same as cash, and so on. So you will get a long list, which is again relatively arbitrary. The German law makes a list of approximately the following things: real estate, which is let to others, shares in capital companies, if this is not for business reasons, if it's a small participation, because then it doesn't give you entrepreneurial influence, so it has no business background, but only a capital investment background. Pieces of art. For example, you as the owner of a firm have, beyond yourself in your office, a statue made by Michelangelo. Why? Well, that really has a representative function. It shows business visitors that you are a highly qualified, educated, respectable person, that you evidently have taste and money, and so on. So that could be called business property, but on the other hand, what it in reality is, or what you could do with that, is that you could do all the collection of the collected paintings from modern artists or medieval sculptures. You could shift it into the firm to decorate the office rooms and the lobby, and then escape inheritance tax. And the answer is no, that should not happen. So we do not accept that. Financial assets. Cash equivalents minus the liabilities, so the net surplus of cash in the firm. Okay, you always need for business purposes a small amount of cash for every firm, so a small amount of cash can be respected as necessary for the functioning of the business, but well, the rest not. So if you are a firm with a huge war chest, as it's called, so an enormous financial reserve in cash and bank account balances, then you might get problems under that aspect. For example, there was in former times a company in Germany which was in the electricity business or electronic articles business, and they had a huge amount of cash, so that sometimes they were joked about and characterized as they are the most influential private bank of Germany, which as a hobby horse runs a group of enterprises dealing in electronic articles. Or Microsoft Corporation is said that at least in former years they had an enormous financial assets amount. So then in that case, so much cash in the firm would have been regarded as unnecessary and would have been excluded from the privileged property. Then later, after you made an inspection of all that administrative property, then again there is to decide, okay, are we going to exclude all that, or are we going to tolerate a bit of administrative property? And the German decision is, okay, if you hold up to 10% only of the, in addition to what's necessary for the genuine business properties, if you hold up to 10% on top in form of administrative property, that is still okay, also privileged. The exceeding amount is not. You remember that 10% is always the threshold for what is material and what counts. So less than 10% administrative property inside the firm means, okay, there is no material amount of administrative property, so we can forget about it. Here you see again that people then begin to think, oh, should a single share and should 100 euro be excluded if it's the only thing compared with several billions? And so they begin to talk about compromises and exemptions from the exemptions, or exceptions from the exceptions. And that is what makes the whole matter more and more complicated. What I presented to you here, the overview of the things which could be administrative property, and then the rules that certain parts of the administrative property can nevertheless remain privileged. That was already a strongly simplified version of what is really laid down in the German taxing. That gives you an impression that alone with the task to determine which part of the business property is now privileged and which is not, and where there is an exception and where there is an exception of an exception and a limit for the exemption of the exemption or of the exception, that already with that you can make your life really into an adventure. So you need to be a highly specialized expert. So you will have to have a look on this, all complicated as it is. Now, you might probably have other wishes to restrict your business exemptions. One wish is probably we want only to privilege business property. So we have to exclude everything what is not serving a business. Okay, that's convincing. And then usually the second idea comes up, well, if some of our taxpayers now invests into a business in China, should we then really protect Chinese jobs? Now there are moral questions, equal treatment of other countries, and there is a rather egocentric and greedy version which says, well, not our country. Why should we renounce on taxes? And if a foreign enterprise goes under, not our problem. That should then be sustained by the foreign state. And so there is a great temptation to restrict that business exemption to investments in your own country. In accordance with that, you had first the version for a small period of time that only business property in the inland is privileged. Then the EU Commission and some clever tax advisors and taxpayers knocked on the door of the ministry and said, "Hey, have you ever read the European Union treaties? Do you know what is the meaning of the word restriction? That's a discrimination of transactions with the rest of the EU in relation to what you do in the inland. And now what you do here is, if somebody invested in the inland, you will later get out of the matter completely free of inheritance tax if you made the mistake to use your freedom of establishment and invest in France or Ireland or Spain. Then you will be hit by the inheritance tax, and this might ruin you. And that is what you really admit, because otherwise you would have no justification for your business tax exemption. So what you, by this set of rules, offer to people is you can invest in the inland, or you have the right to invest abroad, but then the firm and the family will go bankrupt or have huge, enormous financial problems in the long and medium run. So that can't be. So then, due to these protests, the German legislator was forced to extend the business tax exemption also to all business property which belongs to permanent establishments in other member states of the EU or in the European Economic Area. So you have a list now in paragraph 13b, what's privileged property, and it names agricultural and forestry property, naturally, and property of a business in the inland or in the EU or EEA. And a business which is privileged would either be a complete business or a complete branch of a business or a participation in a partnership or something like that, comparable kinds of property, if they are connected with inland property or as far as, or connected, or if they constitute parts of a permanent establishment in a member state of the EU or of the EEA. Furthermore, there is also the constellation to take into account that somebody runs a small GmbH. And in that case, the shares are held by the owner, and the enterprise also shall, that's the intention, always be in the future held by owners from that family. They do not want to renounce on control, so the shares must be also enabled to pass on free on inheritance tax if the shares are not a capital investment, but the shares grant entrepreneurial influence. So also shares are qualified as business property in the sense of privileged business property, even if they held as private property by a natural person. So even if it's a paragraph 17 participation, then the shares in the capital company can be transferred free of inheritance tax under the condition that at least 25% are represented by the shares in question. More than 25%, at least one single share more, gives you the right to block any major decision which changes the statutes of a company, and so this is a blocking minority, where the persons holding the other shares always in the long run need your consent. So 25% plus X always grants you in the long run a decisive influence on the decisions on the of the enterprise. So that turns you from a mere capital investor into an entrepreneur. So that is why we insist on the 25% and more. And then naturally there was the idea that people wanted to privilege only their own firms. So the first version was that the shares should be held in a company in the inland, the seat and place of management in the inland, or then on protest from under the EU aspect in a company which had seat or place of management in the EU or EEA. By the way, Here you must see already how vague and strange such a concept is, because if you have a sole trader who invests into a permanent establishment in the inland and a permanent establishment in Hong Kong, and then inheritance comes and hits on the door, then only the business property inside the PE in Germany will be privileged. Now, if the investor turned his firm into a capital company before, and it's a German GmbH, then what the family inherits is shares in the German GmbH, and then the complete value of the shares will be exempted, including the value of the PE in Hong Kong, or wherever I said it was. And now, surprise! If you had made the mistake to turn your sole tradership into a capital company registered in the US or in China, then you would not have inherited 25% plus X shares of a German or a European company, although perhaps the major part, the most important PE of that company which you inherited was inside Germany. It would then not be privileged property. That's strange, and it shows that very often even highly complicated legal rules in the final effect, when you look close to them, still contain arbitrary elements. Okay, so this comes into play, and this is the only kinds of business property which can be privileged, so you have to pass that test too. And afterwards, you have then to make sure that the business exception is also justified. The purpose was, we want to make it possible for the owner to keep the firm running and to keep the firm in his or her own hands without having to withdraw such enormous amounts of money from the firm that the firm might go bankrupt. So, and we want to keep jobs. Now let's begin with that last condition. Now imagine somebody inherits 100 million in form of a firm, and you say, well, there is a mass of jobs, let's say 1,000 jobs, and with regard to these 1,000 jobs, we do not want to risk that the firm is hit by inheritance tax, so we renounce on the tax. Then the new owner said, oh, thank you, congratulations, let's open a bottle of champagne, and now I'm going to fire 990 of my employees. Then, evidently, the fiscal authorities and you and everyone else would look a bit puzzled. Didn't we just renounce on all the inheritance tax with the intention to preserve the jobs? What did the guy do just now? Fire them all? Not so fair. So you would probably say, if we renounce on inheritance tax with the motivation to preserve jobs, then we insist that a minimum of jobs must be kept. There are then two alternatives offered to the new owner of the enterprise, which are organized in a way that you have to secure that in the average of the, or in the next years, you have to pay a certain amount of wages, a certain percentage of the wages in relation to what you paid before. Okay, well, just got interrupted a bit, so I have to find my point again. Yeah, so the condition would be that you demand from somebody who takes over that firm that this person keeps a certain amount of the employees. It might be that, for example, if the previous owner died at the age of 92 and always refused any changes in the firm, that the new owner must make some reforms and is perhaps forced to reduce a bit of the workforce. So there might be the one variant that you are obliged to keep at least 80% of the workforce represented by 80% of the wages for the next years in the average. Or there is another alternative offered. You can oblige yourself to keep in the average 100% of the wages. So probably you can't fire anybody without hire somebody else for replacement. And then the privileges will be different. You can have a choice on for which obligation you opt. Now, the qualification as privileged property will then be revoked retroactively as far as you fire more people than allowed, so that the total of wages paid in the period for which you obliged yourself to a certain minimum level of wages paid. So if you paid less wages, then proportionally the exemption is revoked, or as far as you part with the firm, so that you sell the firm or sell a complete branch or something like that, or you sell privileged shares in a company, contribute them into another company, liquidate the company, or do some stuff like that. Or you withdraw enormous amounts of money from the firm, so that the original aim of the inheritance tax exemption, we want to make it possible that the firm survives and is shielded against a loss of money due to inheritance tax, that this aim would be undermined if the owner then says, oh, nice, the firm keeps all its cash, no, I take it out and spend it for luxury. So you also set a limit to cash withdrawals and other withdrawals from the firm, or in case of a capital company, you set a limit to dividend payments. And there are even limits connected with other events. The general idea is we want that the firm survives and that the owner is prevented from firing all the people or prevented from, hey, turning the firm into cash and spending it. So that explains all these limits. Yeah. In detail, the German law says that a taxpayer who inherits privileged business property, remember EU, EA or inland, can choose between two options: an 85% model, which says, well, 85% of the privileged business property will be inherited free of tax, and you get also a free allowance with regard to the rest, a free allowance of 150,000, which is, if the rest is much, is gradually phased out. Then you have to oblige yourself to pay in the next 5 years an amount of 400% of the average wage expense before the taxable event, which would mean, okay, this is the same as that in the average your wage expenses must be kept at least an 80% level in the average of the next 5 years of what the firm paid before. So you can rationalize a bit and fire the one or other member of the staff, but not too many. This complete option will only be granted without modifications up to an amount of 26 million euro, because for enormous amounts of money the Constitutional Court has demanded in its last judgment on inheritance tax that in such cases it has to be checked if the privileges are indeed needed. So they have to be phased out for the really big firms. We know from the last but one video that several acquisitions within 10 years are added up together. So also for the application of the 85% option, and the for calculation of the 150,000 allowance and so on. All these business property transfers within the last 10 years are added up together, calculated together, and viewed together. A taxpayer who inherits privileged business property can also choose the alternative model. That's a 100% tax exemption. Then naturally you do need a 150,000 tax-free allowance. But if you opt for the 100% exemption, you have to guarantee that during the next 7 years, so a longer holding period, you pay 700% of the average of the wage expense of the years before. So that means in the 7 years you have in the average never to pay a lower amount of wages than before, which is meant to 7 years you will virtually not be able to fire any member of the staff without hiring a replacement. In practice, that might be extremely difficult. For example, what happens if two people give notice and cancel their jobs, and then you can't find a replacement for them for the next month? The only way you can preserve your exemption is probably then to raise the wages for all the others, so that you end up paying at least 100% of the former wages during that year. Otherwise, in the long run, you will get problems. So not so easy. So there you are, less flexible than in the other alternative. That is why you have a choice here. Also, that is limited to 26 million business property in total. Otherwise, other options apply. Yeah, and these were the two basic alternatives. Now, if the business property exceeds 26 million, which is the beginning of the highest tax bracket, then you can choose either between the solution where the 85% or 100% model are in principle granted, but then gradually phased out with respect to how much you exceed the 26 million limit. Or you have the other alternative that you apply for a 100% cancellation of the tax as far as you do not have sufficient other financial means to be able to pay for the tax. That is regulated in paragraph 20A of the Inheritance Tax Act. So that requires then a careful choice between the two alternatives, and the idea is that for very huge amounts of inheritance taxes, the business tax exemption shall not be granted if it's not necessary. And what can be regarded as sufficient financial means is explicitly described in paragraph 28A, so it might be rather complicated. Now, my personal opinion on the present solution is that the present state of the exemption is highly complicated. It's nearly impossible to look through all the details. You probably need years of experience in giving advice in that area. For tax advisors, it's also highly challenging and risky to monitor the behavior of the firm's owner and of the potential heirs with regard to the future business exemptions. The whole thing is also problematic under legal aspects, especially you get now under fire from two fronts. The first one is the German Constitutional Court has more and more insisted in that for reasons of equal treatment of taxpayers, the business tax exemption shall only be granted to those people who really need it, because otherwise the businesses would fail. And on the other hand, EU law now exactly forbids that, because EU law forbids state aid to firms to at least single firms in order to help them to survive competition. So to renounce on payments which these firms normally would have to make with regard to that these specific firms would otherwise fail. Exactly that is the basic sort of state aid to a firm, and exactly that is what is usually forbidden by the rules on EU state aid if the EU Commission has not allowed this. So there is a high risk that at least that 28A solution could be attacked as not a general rule but a selective one, helping some enterprises to survive competition, whereas otherwise they couldn't stand the usual financial burdens which an enterprise has. So there is a huge legal risk because state aid which you get, which has not been accepted by or allowed by the EU Commission, is automatically illegal, and when it comes up you have to pay it back in full. Just to give a final overview, here you have it, the exemption for business property, so always is only relevant for privileged business property. 13b, you had a list there, administrative property is out, business property is also only privileged if it refers to business property in the inland, in the EU, in the EEA, or shares in an inland EU or EEA company which represent a major percentage of shares. And then you have to ask yourself if it's business property up to 26 million or higher than 26 million, because there the different alternatives are a bit modified. That is roughly the situation which we can keep in mind. Probably I and you will only keep in mind that when it comes to the details, it's highly, highly complicated. And this is probably the natural consequence of that, well, deviation from simple underlying principles, and from that here the basic logic which underlies a tax on wealth, you will have to give away a bit of that wealth, and you will probably have to sell a bit of it, then that this basic logic is here now regarded as not fitting. So this is a direct conflict. The concept of the tax demands that you part with a part of your property, and here now one wants to achieve the exact contrary, and then the two kinds of properties can always be turned into another. So you see that the red line which separates the two, private and business property, must be rather arbitrary, and so the chaos is programmed. Good. And by the way, we still have another exemption or privilege with regard to business property. As far as business property is taxable, you privilege business property only again. You also get the tax rate of tax class 1 always. In practice, that could also already be achieved earlier, because even before that rule existed, there was a very simple and clever trick for business owners who had no direct heirs of the next generation, no children of tax class 1 to which they could pass on the enterprise. They just chose a wanted successor and then adopted that successor as a child. So automatically tax class 1 was guaranteed. If you had a clever tax advisor and had courage enough to play a bit with civil law. So when this first, that was historically, by the way, the first privilege for business property, which was established, when this privilege was established, that was not really an unaffordable generosity. Good. Later, by the way, naturally, also this privilege was limited and granted only under the same conditions which had to be fulfilled for privileged business property in the 85 or 100% option in general. So, well, in practice, probably not so high important. Again, only privileged business property is regulated by that. Good. That was my overview about the special rules which exist for business property in German law. It probably makes no sense to memorize them in detail, but what you keep in mind is that they are highly complicated, that they depend on conditions which you have to supervise during several years after the taxable event happened, and that, well, then if you get a case to solve, depends on whether there is information all the conditions will be kept in the future, or if there is information that certain conditions are definitively not met in the future. By the way, naturally, in practice, you will be first assessed under the assumption that you keep the promises which you give, and later when you violate them, the assessment will be reopened, redone, and you have to be confronted with a changed tax notice and have then to pay the amount as far as a higher tax results from any violation of the tax rules. Good. That shall be enough for this time. I genuinely do not know why the camera didn't work in the first part of this lecture, so just enjoy that you didn't have to see me during the first part of this lecture. I hope next time everything will be better. Thanks for watching, and goodbye till next time.